In this video, I'll break down what stocks and ETFs are, the types that you'll come across, how they actually work, and how to choose the right one depending on your goals, your risk appetite, and mindset. Let's get into it. Last time we spoke about different places people invest their money, from stocks and ETFs, gold or silver, real estate, and crypto. But let's be honest, if you're just starting out, it usually comes down to these two things: stocks or ETFs. You have heard someone say, just buy that index, or some other person say, I've made 40% on Tesla. Now you're sitting there and wondering, what does that even mean? In this video, I'll break down what stocks and ETFs are, the types that you'll come across, how they actually work, and how to choose the right one depending on your goals, your risk appetite, and mindset. Let's get into it. Stocks versus ETFs, the real difference. Let's keep it simple. Stocks are individual companies. You believe in Apple, you buy Apple. You believe in Infosys, you buy Infosys. When I say you buy Infosys, you buy a share of Infosys. Right. ETFs are bundles. One single ETF can hold companies like Apple, Microsoft, Google, Coca-Cola, and 496 other companies all in just one go. So when you buy ETFs, you're not just betting on one horse, you're buying the whole field. ETFs work for most people because you don't have to research individual companies. The cost is very low and you get instant diversification. Now, that said, individual companies, well thought out and well researched individual stock, could outperform ETFs, but that also comes at higher risk, higher volatility, and higher effort. It really depends on how much time and energy you're willing to put in. Types of ETFs, what's actually inside these things. Now let's get into what are the different types of ETFs that you'll actually see. I'd like to break it down into three categories. The first one is broad market ETFs. These ETFs track large indexes. For example, top 500 companies in the US, 50 top companies in India, or 300 top companies in Australia. They are slow and steady, perfect for long-term investing with less drama. You can see some examples of broad market ETFs on the screen here. The next is sector or thematic ETFs. These zoom in on a specific theme or an industry. For example, tech, clean energy, global healthcare, or even AI. These are trend-based. They grow fast during a boom and could crash just as quickly when the hype dies down. I'd like to think of sector or thematic ETFs as a seasoning. They are great in small doses, but not as your whole portfolio. Some of the examples of sector and thematic ETFs are on the screen here. The third one is dividend ETFs. These ETFs are made up of companies that regularly share profit to its shareholders. The idea is simple: to have some cash flow while your investment hopefully continues to grow. Here are some things that are often missed. Dividends aren't guaranteed. A high yield or high dividend isn't actually a good sign. Sometimes it means that the company is struggling. Also, a high dividend ETF grows slower than others. These ETFs in general are great for income stability for someone in retirement or someone who has taken long breaks from work. But this may not be the best option if your only motive is to have high growth. Some examples of high dividend ETFs are here on the screen. So just to recap, we spoke about three types of ETFs. The first one was broad market ETFs that usually track some kind of an index. The next one was sector and thematic ETFs, usually trend based. And the third one is dividend ETFs, where you have some sort of a cash flow. DCA versus lump sum investing. Now let's talk about how you invest and how you behave after you invest. DCA is dollar cost averaging. It means that you are investing smaller amounts regularly. The frequency could be weekly, fortnightly, monthly, or even quarterly. You are just investing regularly, so you are consistent. This works great if you are just starting out. You don't want to stress about the entry points and you're trying to build the habit. So the other alternative is lump sum investing. This means that you are investing bigger amounts all at once. If there is a crash, if there's a market crash, or if there is a dip, people do lump sum investing. It works if you know what you're doing and you stomach the volatility. But if you do lump sum investing and you're hoping the market bounces back next week, then lump sum investing may not be the right one for you. It is only going to cause stress. DCA might be a better option for you, but here are the two options: DCA and lump sum investing. Maybe you could do both if it works for your lifestyle and your if you have enough emergency funds and everything sorted. Maybe you can do a bit of both, but this is the general idea. Set and forget versus active selling. Now let's talk about what you do after you have invested. Set and forget means you invest and then leave it alone. You don't check every single day. You don't panic sell for when there is a downturn. You just let time and compounding do their thing. The alternative to set and forget is active selling. This is where you buy and sell based on news, market moves, or to lock in profits. There's nothing wrong with active selling if it aligns with your goals. But there are some things that you need to consider with active selling. Every profit that you make, you will have to pay capital gains tax. There's a transaction fee involved every time you buy and sell. The third thing is, unless you are a professional, you may not be able to time the market. And timing the market is usually a losing game. So unless you have a clear strategy and not just vibes, set and forget is usually better and tax-friendly choice. Emerging markets, high growth or high drama. Emerging markets get a lot of hype. Countries like India, Vietnam, Brazil, etc. all are seen as next big thing. And yes, many of these economies are growing fast. They've got young population, rising middle class, and higher digital adoption every year. But here are some things that's not always said. Emerging markets are volatile, politically, economically, and currency wise. Not all emerging markets grow at the same rate. And emerging markets ETF as a bundle can include high performers and underperformers in one fund. So if you are interested in this fund, be picky. A country specific ETF like one focused in India or just Southeast Asia may make a bit more sense than emerging market ETF as a bundle. And remember, even when you're feeling bullish, these should be a small part of your portfolio. High reward often comes with high drama. So far, we have covered what is stock and ETF. We have covered different kinds of ETFs. We have also spoken about strategies for buying and strategies for selling. We also slightly touched on emerging markets. Some things we have learned so far is you don't need to be perfect. You don't have to chase returns. You just have to stick with it longer than most people do. Let me know in the comments below if you are team ETF or you pick your own stocks or you're still figuring all of this out. I'd be super keen to know. I'll see you in another one. Bye.